Markets can keep going up even while the foundation quietly weakens. The real question is not whether prices are high. It is whether the math underneath them is starting to matter again. In our strategy, we do not forecast outcomes. We sequence risk. We look at how liquidity, cash flow, positioning, and sentiment interact over time, and we ask where pressure is quietly building. This discussion comes from Thoughtful Money, where Adam Taggart spoke with Chance Finucane of Oxbow Advisors. Rather than focusing on predictions, the conversation centered on something more subtle. Prices have run far ahead of free cash flow, especially in a narrow group of market leaders. That matters because markets ultimately price cash flows, not stories. When large companies increase capital spending faster than returns materialize, free cash flow compresses. As long as investors stay optimistic, that gap can persist. But once skepticism appears, the adjustment often comes through valuation rather than earnings. This is why markets can look stable while risk quietly rises. Liquidity, passive flows, and momentum can delay recognition. Our strategy treats that delay as a signal environment, not a green light. What we are seeing now is not a clear breakdown. It is growing phase 2 pressure, leadership concentration, rotation beneath the surface, and stretched cash flow multiples all point to a market that is becoming more conditional. Rotation does not mean everything falls at once. It means yesterday's leaders stop doing the heavy lifting. That is often how late cycle transitions begin, not with panic, but with subtle underperformance. If this way of thinking resonates, following the channel can be useful. Subscribing helps you build context over time, so each new discussion fits into a larger framework rather than standing alone as noise. The conversation also highlighted why commodities and energy are attracting attention, not as a trade, but as a response to inflation volatility and shifting leadership. In our strategy, that fits with a regime where real assets regain relevance without requiring a crisis. What has not changed is discipline. We do not chase crowded leadership. We do not assume valuation alone causes reversals. We wait for confirmation across credit, liquidity, and breadth. This is educational analysis only. It is not financial advice and not a recommendation. From here, the signals that matter most are simple. Does breadth improve or continue to narrow? Do cash flows begin to catch up with prices? And does volatility remain contained or start transmitting into credit? We do not need to be early. We just need to understand where we are in the sequence and what would tell us that the phase is changing.